Ladies and gentlemen, good day and welcome to the JKCEMENT Q1 FY23 call hosted by PhillipCapital India Private Limited. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star and then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vaibhav Agarwal from PhillipCapital India Private Limited. Thank you, and over to you, sir.
Yeah, thank you, Inba. Good evening, everyone. On behalf of PhillipCapital India Private Limited, we welcome you to the Q1 FY23 call of JKCEMENT Limited. On the call, we have with us Mr. Ajay Kumar Saraogi, Deputy Managing Director and CFO, Mr. Sumit Khandelwal, Deputy CFO, and Mr. Prashant Seth, President, Business Information and Investor Relations. I would like to mention on behalf of JKCEMENT Limited and its management that certain statements that we made or discussed on this conference call may be forward-looking statements related to future developments and the current performance. These statements are subject to a number of risks, uncertainties, and other important factors which may cause the actual developments and the results to differ materially from the statements made. JKCEMENT Limited and the management of the company assumes no obligation to publicly alter or update those forward-looking statements, whether as a result of new information or future events or otherwise. I will now hand over the floor to the manager of JKCEMENT Limited for their opening remarks, which will be followed by interactive Q&A. Thank you, and over to you, sir.
Yeah, thank you, Vaibhav. Good evening. The Board of Directors met on 13th of August to review the working of the company during for the first quarter ended 30th June 2022. The major highlights were the revenue from operations stood at 2,066 crores as against 2,269 crores and previous quarter, the last quarter of FY22, a drop of 5%. The other income was lower by 46% at 22 crores as against 41 crores. The operating expenses were lower by 6% at 1,766 crores as against 1,886 crores. The EBITDA number during the quarter was 405 crores, higher by 2% as against 397 crores. The depreciation was higher by 19% at 90 crores as against 76 crores. For this depreciation, we have reviewed the life of some of the power plants, and accordingly the additional depreciation has been provided for. The finance cost was lower by 10% at 62 crores as against 69 crores. The profit before tax was 271 crores as against a drop of 3% as against 279 crores. The profit after tax was 271 crores as against 149 crores, an increase of 81%, because in the previous quarter impairment of Fujairah was considered. The provision for tax was 90 crores as against 63 crores, and the profit after tax was 181 crores as against 86 crores. The EPS during the quarter was rupees 23.44 as against 11.16. The EBITDA margin for the quarter was 19.08% as against 17.87%. If we compare the working with year on year, the revenue from operations were higher by 33% at 2,166 crores as against 1,634 crores. And the EBITDA was 405 crores as against 402 crores, almost flat, just higher by 1%. The depreciation was again higher at 90 crores as against 66 crores. The finance cost was 62 crores as against 56 crores, and the profit before tax was 271 crores as against 305 in the year on last year, a drop of 11%. And the profit after tax was 181 crores as against 208 crores, a drop of 13%. The EPS 23 rupees 44 paisa as against 26.95. The EBITDA margin was lower at 19.08% as against 25.11%. These are the major financial highlights. As regards the project is concerned, the greenfield expansion at Panna is at advanced stage, and the company expects that this will be commissioned within this year, though our efforts are on, and it may be possible that the plant goes on stream in the third quarter itself. Up till now, we have spent about 2,072 crores on the project. If you look at the debt profile, the gross debt during as of 30th June was 2,785 crores as against 2,850 crores. The net debt was 1,727 crores as against 1,606 crores. Net debt to EBITDA is 1.12 times as against 1.05 as on 31st March. And the net debt to equity is 0.39 as against 0.38. These are the major highlights. If you have any questions, I will be pleased to address the same. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question may press star and 1. We'll take our first question from the line of Shravan Shah from Dolat Capital. Please go ahead.
Thank you. First of all, congratulations on relatively better performance, particularly on QoQ improvement in EBITDA per ton. So now coming to the questions. First, in terms of the pricing, so post June, how much price decline we have seen in North, Central?
So in the north, there's a drop of about 10 rupees, 10 to 12 rupees a bag. Central India is not our main market, so it's very difficult to say what is the real fall in that market. But the major one is in the north.
And in South, sir? South and West Karnataka and Maharashtra?
South also, South is not much change, about 5 to 6 rupees.
Okay. So the second, now the question is on the power and fuel front. So our consumption cost, what was for Q1 FY23, and how do we now see cost in particularly in the Q2? So are we now starting to see the cost, power and fuel, to decline from the Q2, or it will be from the Q3?
So actually, we still got benefit of the low cost fuel in the first quarter. So the full impact of the high cost fuel which we had procured has not, the full impact is not still there, and that would be seen in the second quarter. So we see that in the second quarter, our fuel cost would be higher than the first quarter. So no question of any decline right now, but second quarter would be the highest fuel cost for I think for all times to come.
Any ballpark number, 10-15%, so 100-150 rupees kind of?
It should be higher, as compared to, the power fuel cost it could be higher about 200 or rupees a ton.
Okay. Got it. And in terms of the couple of data points, so OPC, PPC share, railroad mix, lead distance, fuel mix for this quarter?
Yeah, the OPC, PPC, like PPC was 64% in this quarter.
Okay.
The trade ratio was 69%. Railroad was 17% to 83%.
Okay.
And lead distance was 475 kilometers.
Okay, lead distance has increased.
Yeah, it has increased because of the new markets. Because we are seeding the new markets of Central India from the existing plants. Lead distance has increased.
And fuel mix?
Fuel mix is around 50% petcoke, and balance is the imported coal and the alternate fuel.
Okay, got it. Sir, just to clarify, when we said that we have reviewed the life of power plant and that's why the depreciation has increased 14 odd crore this quarter. So this 90 odd crore quarterly is a normal run rate that we can see now?
Yes, I think because this would be the run rate because this is impact only in this quarter. So annual impact of review of life of the various power plants is around 60 crores.
Okay. And lastly, on the capex front and the date front, so now as you mentioned that most likely we will be starting Panna by this quarter. So this will be both Q3, sorry, by December.
We are trying. Though, yeah, initial was, by FY23, but we are working on it and we are hopeful that maybe in quarter 3 we are able to start Panna.
So this will be both even grinding also the entire 4 MTPA grind?
There could be a manner both during the quarter itself. This is what we feel that bearing any unforeseen we should be able to do. So well, as we said, definitely in all circumstances the plant would be on stream during this fiscal year. But so what our working is that our work is at a very advanced stage and satisfactory stage, and we are hopeful that maybe in the third quarter itself we commission it.
Okay, so for the full year in terms of the capex now, how much we will be spending? So including the Panna, what is left that to be spent, and apart from that, even the paint and maintenance. So what would be the full year capex this year and then the next year?
Yeah, that as we have conveyed, the annual plan is for 1,700 crores of capex. So in all, there will be around 1,150 crores of capex for the Panna, and 150 crores for the paint, then 325 crores for the sustenance capex, and balance is what we are planning, maybe some expenditure on the future plan of the 2 split grinding units.
Okay,
in all, it would be in the range of 1,700 crores.
Okay. Thank you, sir, and all the best.
Thank you. A reminder to our participants, if you wish to ask a question, you may enter star and 1. The next question is from the line of Rajesh Kumar Ravi from HDFC Securities. Please go ahead. Mr.
Hello.
Yes, sir. Go ahead.
Yeah, am I audible?
You are.
Yeah. Hi, sir. Congrats on good set of numbers. I have a few questions. First, would you share the UAE product sales volume, total sales from UAE facility?
Yes. Yeah, UAE volume in this quarter was 1,25,000 tons.
Okay. And you missed out on the fuel cost on a per kcal. What was the number for Q1 on consumption basis?
Consumption basis, the average fuel cost for the Q1 is around 10,000 rupees per ton.
No, it is actually on per ton. It's about 2 rupees 30 paisa is the consumption.
And this, how did this change versus Q4, sir? And where do we stand in Q2?
So Q2, should be around 2 rupees 75.
And Q4 it was how much, sir?
Q4 it was 230, I think. It was about 220, 230.
Okay, so for you,
it was more or less in the same range, like Q4 versus Q1 was more or less same.
okay, so this is surprising. While everyone faced a 15 to 20% inflation, you have been able to manage with flattish sort of a number on a Q-on-Q basis.
So basically,
Yeah,
like
that is there. That is the benefit which we are seeing, but it will not be visible in the second quarter.
Correct. No, everyone is in the heat in Q2 for sure. But do you see this 275 Q3 onwards tapering down?
See, the fuel prices have come down. We have ordered, but partially yes, it would be seen in the third quarter, but there would be some impact of the high cost inventory even in the third quarter, though not for the full quarter, because by the time the low cost fuel inventory reaches the plant, so we have a blended thing. I think if the average can come down to something closer to Q1 or something.
Okay. In Q3 you're looking some tapering off back to Q1 numbers situation. Okay. Sir, what is the total project cost for the central expansion Panna and Hamirpur?
So it is 2,970 crores.
Okay. And you said how much is pending on this for this financial year, FY23?
1,150 crores will be in this financial year.
Okay, 1150 crore in FY23, because as from your presentation, okay, end of Q4, you have already spent
See, until now we have
crores.
spent 2,072 crores.
Correct,
So
yes.
balance, about 900 crores needs to be spent. So some amount there will be a spillover, because again payments and performance guarantees, there will be some shift on, and the waste heat may get shift to, so we are trying to do it within this fiscal, but maybe partially in the first quarter of next fiscal. So there would be about 300 to 400 crores capex, actual cash outgo, which may be there in next FY24, but balance, majorly about the expenditure of 2,600 crores should be spent in this year, broadly.
Okay. And one last question, what is the status on the paints project, sir? How much you mentioned you are spending capex in this year. So what is the status in terms of the plant finalization, land and all?
So we have got the permission for land, and the land has been allotted to us. It is at Mathura in UP, so the land has already been identified. Now we are in the process of getting the land acquisition and other approvals, and in the meantime we are also getting the quotations for plant and equipment and other things. So we should be finalizing that all these things within next 2-3 months time.
Okay, and by when this plant should be up and running?
Now the schedule remains the same, that by March 24, we should commission the paint plant.
Okay. And the capex in first 2 years, total capex, not your investment, that will be done for next 2 years?
Yeah, so it is the 600 crores is spread over a period of 5 years, as we said
Correct.
earlier.
Okay. So this plant will be up and running by spending this 2 years, this year and next year, around 250 crores. The plant should be operational.
No. So the next year we are planning to spend 125 crores this year. The next year expenditure is higher. It's about the next year expenditure would be about 200 crores, because the plant will be commissioned, and then we spend on the branding and other things. So the balance, 300 crores to get spread over the next 3 years.
Okay. Sure, sir. Thank you. We'll come back and queue.
Thank you. Any participant who wishes to ask a question may enter star and one. Our next question is from the line of Naveen Sahadev from Edelweiss Securities. Please go ahead.
Yeah. Good evening, sir.
Yeah, good evening.
Yeah, couple of questions. Thank you for the opportunity. Sir, first of all, I am just looking at your presentation, which says the CO2 emissions in per kg terms, kg per ton terms. They have gone up slightly in Q1 23 over the average of 22. Is it because of any change in the sales mix per se, in the sense, did we produce higher, was the share of OPC or unblended cement?
No, Naveen, this is actually relating to the emissions on account of the power and the usage of the alternate fuel. So this is a minor variation which keeps on coming. So it is not very significant also.
No, it's not significant. I was just a little confused with the fact that...
It is on account of the solar power and the alternate fuel relating emissions, which is seeing some variation.
And Naveen, just to add to Mr. Prashant, last year we had been operating some thermal power plant in some of the months. And this year we had not operated the thermal power plant, and unfortunately for this calculation, thermal power plant generation is not considered, basically. And that much power we had bought from outside. Because of that, basically it has gone up. So it is issue of mix of power source.
Yeah, no, sorry, I was just looking at it a little confused because green power mix, just the chart below that, that exposure from 32% has gone up to 41%.
That is the reason, as Sumnesh ji is telling, because captive power, the coal-based captive power is not a green power. Now we have stopped the captive power and we are procuring the solar power, which is coming into the green power. And in case of the solar power which we are buying, the carbon emissions are being added. And for the coal-based captive power, those are not being added as per this system. So that is why increase of the green power has resulted into increase in the emission.
Sure. And just staying on this a little bit, once we start operations in Panna, what kind of change, on a fully ramped up basis, what kind of change can we expect on the blending ratio or the CC ratio per se? Because I believe Central India per se is a much higher blended cement region versus, let's say, a north or even west or south or west for that matter. So how much should that improvement be?
So, that will depend. Today, all the new markets we are entering is all blended cement. We have to see for initial ramp up what is the institutional sale which comes, and we have to see what on the blended cement. It will depend on the institutional demand. Yes, as far as trade is concerned, it will mostly be only blended cement.
And just to add to Saraogi, basically from Hamirpur, it will be there will be substantial increase in blended cement because it will be producing only PPC. But as far as Panna is concerned, since our focus will be to capture the market first, basically. So initially there might be some higher quantity of OPC, but gradually it will keep reducing and blended cement will increase.
Understood. Just one more question, if I may slip in, please. Staff cost sequentially has seen a increase of almost about 17.5 or 18%. So just wanted to, is this because of salary increases and in general the entire impact coming in? Because, and post Panna then this is set to, this should ideally then improve further post Panna commissioning.
So, for the staff, yes, the impact of the increments is there. Also, the additional marketing staff which we have taken for the new markets. So the additional manpower which is required for the new market is also built in the staff cost. So there would be no only the plant staff which is presently being capitalized. That should come in, once the plant starts. So going forward on the per ton basis, yes, absolute amount would be higher, but we will get after the panna production, the per ton cost will come down.
Sure. Just one last question, if I may. These grinding units, which you said there's going to be some capex identified for at least 2 more split grinding units in central India. Have you finalized their location?
Yeah, so one is in MP and the other one is in UP.
Okay. Okay, and if I may just ask, eastern part or western part, or some color here, or maybe we can share it probably next time if you come.
No, actually we have in the eastern UP and on the west is towards Indore and Ujjain is the place closer to that. We have other option, that is the MP location. Towards east UP, so we just finalizing on that.
Understood. That's helpful. Thank you very much and all the very best.
Thank you. Any participant who wishes to ask a question may enter star and 1. The next question is from the line of Sanjay Nandi from Ratnabali Investments. Please go ahead.
Yeah, good evening, sir. Thank you for the opportunity. Sir, as we are very close with the startup of our Panna plant, so can you just share the demand supply dynamics which are prevailing in Madhya Pradesh? Like what kind of productions we are eyeing for that startup, that Panna plant?
So as far as production is concerned, we expect that we should be doing in the next fiscal anything between 50 to 60% of the capacity. So the capacity is 4 million tons. So that is the number which we expect in the first full year of operation.
First year operation. And sir, going forward, so we will be talking to that industry standards norm, right, sir?
Going forward, industry.
Yeah.
Okay. So that's it from my side. Thank you so much, sir. Wish you all the very best.
Thank you. Our next question is from the line of Sumangal Nevatia from Kotak Securities. Please go ahead.
Yeah, good evening, sir. Thanks for the opportunity. First question, just one clarification on the prices. You said around 8 to 10 rupees decline. Is it possible to compare the prices versus 1Q as an average?
Q1 as an average. Over?
Yeah, what are the current prices versus 1Q average?
The current prices would be on an average lower by about 15 to 18 rupees a bag.
Okay, and this is gross price, right? I mean, at the retail level.
So retail level, see the pricing today different districts, it will range from anything from 360 to 380 rupees a bag presently.
Okay, and this is north, if I'm not mistaken, and with respect to south?
South, it will be about 20 rupees lower.
Understood. So next question, you said in the earlier question that around 50 to 60% utilization in the first year. So given that it's going to be a significant ramp up and a growth, I mean, any sort of marketing, selling expense, etc., which will be front loaded in the first year?
I didn't follow.
I'm asking with respect to a Panna expansion. We are expecting around 50-60% volumes 50 to 60% utilization of the plant in FY24. Now, since it's a very sharp increase in the overall volumes and it's a new region, I mean, any front-ended marketing or selling expense which we will see, or it will be a normalized, or it will spread over a period of few years?
It will spread over. We have already started, started opening up of the new markets which we have to feed from Panna. And so presently also, around in the new markets itself, we are selling around 40 to 50,000 tons a month. So we are already seeding all the markets, and when we see all over the branding spent and other things is part of that. So there would be additional branding spent would be there, but it will get compensated by the additional volume.
Understood. And one last question, the future split grinding units, what sort of configuration, I mean, overall size would it be, and should we expect that to be commissioned sometime in FY25?
Yeah, before FY25. And
Okay.
it should be additional what we have a plan, not yet approved by the board. So we are working at the stage of additional, to add up, which is also given in our annual report, if you see, that we intend to do additional around 6 million tons. This would come, by way of one, we are also working out on possibilities of revamping of some of our existing grinding capacities and installation of new grinding capacities.
Understood, sir. Thank you and all the best.
Thank you. Our next question is from the line of Prateek Kumar from Jefferies. Please go ahead.
Hello. Yeah, good evening, sir. My first question is on your trade mix, so which has sustainably remained now in the higher range of 65 to 70%. So post stabilization of Panna operations, are we looking at stabilizing it here, or are we also targeting higher than 70% for overall company?
So our ultimate target is for the company, we want to achieve 70% plus as a trade volume. And even for Panna, presently we are seeding all the markets, and from the grinding station, it should be mostly trade volume. It would be blended cement and mostly catering to the trade market. And from the integrated plant, because normally if you see, the non-trade segment is only more of OPC rather than on blended cement. So even with Panna, we expect that we should be able to maintain, the range of initially the range of 65 to 70%, and then increase further beyond 70%.
Sure. Thank you.
And also, one other important factor is this is definitely, subject to how the future demand. If all incremental demand comes from institutional, where there is a need to, to get the market share, one has to sell more in the non-trade segment, then definitely there would be some correction on the trade non-trade ratio. Because in any case, trade, we are increasing, we are working towards increase of the trade numbers, but there is a limitation to increase in the trade if the demand is not increasing in that segment.
Yeah, one more question. On cost of operations, once the Panna commission, so how would the cost of operation at Panna compare to the overall grey cement operation cost of the company?
So the Panna costing would be, similar. I mean, as a new plant, it will be more efficient, but the initial first 3 to 6 months, maybe stabilization period, and thereafter post 6 months, say from the third quarter onwards, next fiscal, we should see one of the best costs coming in out of the Panna operations.
And lastly, sir, on demand trends, how is now we are probably entering towards second half of monsoon. So how are we looking at demand on year-on-year basis, going forward, like post-monsoon as well?
So we are expecting a good volume growth post-monsoon. So in fact, we expect that even from September itself, there should be some improvement in the volume numbers.
Sure. Thank you, sir. These are my questions.
Thank you. Our next question is from the line of Tejas Pradhan from Citigroup. Please go ahead.
Hi, sir. I just wanted to check. You mentioned in your annual report that you have started tolled operations for wall putty. So could you give a sense what sort of volumes can be expected from this method?
So not big volumes, but these will be a small 1,000 to 1,500 tons coming from each location per month, and then step up to 2,000, 2,500 max, and then go to different more locations where you're having a distributed manufacturing helps in faster development of the market. I mean, you are able to service the market better because these areas, everything covering from Katni or from Gotan, once you more lead distance, your service factor gets affected. So ultimately you are able to do better servicing, and it is only the servicing which matters now in marketing. It's a very important thing besides the quality and other parameters which we are in any case maintaining, but service has become very important.
Okay. And would the cost for this be similar to your own plants or?
Yeah. So ultimately, distributed manufacturing should also result in over a period of time would also result in savings in costs.
Savings in okay. And just finally, sort of as a follow-up to what was discussed earlier as well, you had mentioned 25 million ton grey cement capacity roadmap by FY25. So for this, clinker would largely come from existing operations, or any debottlenecking, etc., would be planned for this thing?
Yeah, so we do see some once the Panna stabilizing, so Panna would meet out the whatever is the balance requirement of clinker that will be met out of incremental production which we see we will get from Panna. Presently, all our things we are marked at 8,000 TPD from Panna, but we see a definite potential of 10,000 TPD from the Panna kiln.
Okay, so Panna can go from 8,000 to 10,000, and that itself should be enough for the 25 million tons.
Yeah.
Okay. Thanks.
Thank you. Ladies and gentlemen, you may enter star and 1 to ask a question. Please note this is a final reminder for questions, and no further reminders will be placed after this. We will take our next question. It's a follow-up from Shravan Shah of Dolat Capital. Please go ahead.
Thank you. Sir, clarification in terms of the employee cost when we mentioned, so this quarter 143 odd crore kind of employee cost for the quarter on standalone. So this run rate, as you mentioned, it also includes the increment also. So from next quarter, this is the standard, and once the Panna will start, maybe we will see another 5-10 crore increase in that. Is that understanding right?
See, as of now, the Panna cost will not appear because JK Cement is doing the marketing of the products. The employee cost for marketing is appearing in so Panna would, unless we have a merger plan, unless Panna gets merged with JK Cement, it will not appear in the standalone audited results. It will only come in the consolidated results.
Okay. Let's assume if it gets merged, then this quarterly run rate will be after the Panna gets starting from Q1.
Whatever is the plant cost, that will come additional. There will be some additional marketing cost also, because a few more depots are being opened to cater to the whole market, because with Panna, we shall be covering the entire state of MP and UP. So that would be the ultimate market with Panna. With Panna, we shall, our market reach, we will be covering the entire state of UP. We shall be covering the entire state of MP.
Okay, got it. But still, so this from the Q2, this 143 crore, this run rate will continue. And
for Q2 and Q3, I don't think so there should be any major change.
Okay, but once the Panna gets merged, then this employee cost will increase by how much?
So whatever has been, we are talking about is 143 crores. So you may have an additional about 10 crores, 10% on this amount.
Okay, got it. And second clarification, so currently this Panna clinker plus 4 MTPA grinding, so this 2 grinding one is at an integrated 2 MTPA and 2 MTPA is at Hamirpur, and the additional, the 6 MTPA we are talking about, this we have identified one location Indore and second one is Eastern UP.
One is in MP, not Indore here. The location is not again finalized and approved by the board, so I am not taking the exact location. One is in MP and one is in UP. Near Indore, I said. I didn't say Indore. Around and so the location has not been announced yet. So we'll let you. So one location is there. One location is in Eastern UP.
Okay, so there broadly though we have not finalized, but in terms of the additional grinding which will come would be 2 MTPA at each location. So 6 MTPA when we are talking, maybe max we can look at 3 locations.
So there will be these two new locations. Plus we are revamping some of the existing grinding at our existing grinding stations across integrated plant and the grinding plants. So there some grinding enhancement would be there. So with all that, the total incremental across would be about 6 million.
Okay. And only the 2,000 TPD increase in clinker at Panna would be sufficient for the entire 6 million ton extra grinding that we are looking at. And this entire 6 MTPA would be starting by FY25 or it will start from FY25?
It should start within FY25.
Okay, so we will add entire 6 MTPA by FY25. And only the clinker extra 2,000 TPD clinker from Panna will be sufficient.
See, we already have excess clinker today. After the modification which we had done in Nimbara, we have clinker. We are not operating, the older kilns as of now. So we have sufficient clinker available. So as and when, we have the grinding capacity, and as the demand picks up, we shall be utilizing all our clinker facilities.
Okay, and broadly, roughly, on a rough basis, this 6 MTPA, the capex would be per MTPA would be how much? 200 odd crore?
200 odd crores?
200 crore per 1 million ton grinding unit. So I'm just trying to understand the capex.
It should be well within that, yeah.
Okay. And lastly,
I'm not giving any numbers because the numbers have not been. We are only discussing certain theoretical numbers. That yes, you said 200 crores per million, so you're talking about maximum up to 1,200 crores. I say yes, well within. This is what we feel that it should be done within that.
Okay. So then the maximum peak date, if we factor that, how much maximum peak date are we looking at? So from here on, can we see another 700, 800 or 1,000 crore max increase in the peak date?
So when we talk about peak debt, today we have standalone gross debt of 2785 or net debt of 1727. We are yet to draw about how much is left to be drawn? About 800 crores has to be drawn from the banks, and there could be some additional borrowing. Yeah, I think the net peak debt should be around 3,300 to 400 maximum.
Oh, okay. Got it, sir. Thank you and all the best.
Thank you. The next question is from the line of Girija Ray from Systematics Group. Please go ahead.
Hello. Thanks for the opportunity. Hello.
Yeah.
So this 2,970 crore of capex, so that includes WHRS also in Panna.
Yes, 2,072 crores on Panna.
Yeah.
This includes, and the project cost of 2,970 includes WHRS.
And we are setting up WHRS in Karnataka also. So that also included in that, right?
Panna WHRS, there is a 22 megawatt WHRS which is included in the project cost. It is being installed at the Panna site.
Okay. But in annual report, we have mentioned in Muddapur, Karnataka also we are setting
That is not in this project cost. That will be part of the normal sustenance capex.
So that will be somewhere around 250 to 350 crores, right? In between that.
So
is that sustainable?
No. See, what is talked in the annual report is this 22 megawatts is part of the Panna project. Then we have a plan to put up a WHRS at Muddapur, the south plant, which in Karnataka, where we do not have a WHRS. So that details are being worked out. So that would be an additional capex of around 175 odd crores to 200 crores. That would be separate.
And regarding solar and wind power, 38.5 we are adding up. So which location we are adding this?
So solar and wind is across all our locations, and it is more on a group power basis. So it is not based on capital as on yet. So there we are only investing marginally in the equity of the group power provider. So we only invest in the equity and we get that power. So it is across all the locations we are working on.
Thank you, sir. Thank you very much.
Thank you. We'll take a next question from the line of Prateek Kumar from Jefferies. Please go ahead.
Thanks, my questions are answered.
Thank you. We'll take our next question. It's a follow-up from Rajesh Kumar Ravi from HDFC Securities. Please go ahead.
Yeah, hi sir. I have two follow-ups. First on the capex guidance for FY24 across all projects on a console basis.
It will be 1,100 crores.
Okay. So that would primarily be towards the Muddapur WHR and the 6 million ton grinding.
Lower capex of the Panna plus the normal capex, including the WHR, then whatever is there for the grinding locations plus paints, everything.
Okay, understood. And what is the volume guidance for FY23?
So FY23 So we have about 10% increase in the volume numbers.
This is on Concall or grey cement you're looking at, sir?
This is Concall.
Okay, Concall 10% volume growth. Okay. Now coming to this Panna expansions, we are adding 2.5 million ton clinker, which obviously will increase to 3.3. This 22 million this WHR capacity is for this capacity or inclusive of future expansion?
No, see, the WHRS is linked to the kiln capacity.
Correct.
So it is based on the present kiln capacity. So there is only one kiln at Panna at this point of time. Unless we come up with line 2 at Panna, then there would be additional WHRS. Otherwise, there's no additional WHRS.
Okay. Why I'm asking, isn't the number too high from a kiln throughput perspective, 2.5 or 3 million ton yielding 22 megawatt of WHR?
It's not too high.
Okay. And what? Sorry.
This is the norm now.
Okay. Good to know that, sir. And sir, for this Muddapur, again, what sort of capacity you're looking at in terms of WHR? Because it's 200 crore capex. Is it close to similar number, 18-20 megawatt?
Close to 20 megawatts, yes.
Close to 20 megawatt. And last question on the clinker capacity. You said this 6 million ton with this debottlenecking of 0.7 million ton. You would be able to fund that, because if I look at your total capacity, clinker capacity today, this is around, even with this Panna project getting commissioned, 13 odd million ton clinker capacity. So, if I take a blending of 1.5 times cement to clinker ratio, for 25 million ton, you would require around 16 million ton. So still 3 million ton would be required. So are we looking at debottlenecking opportunities across all the three locations?
No. So I said we'll get an incremental clinker coming in from Panna. So that 2000 TPD, so that you will get. And then when we talk about 25 million ton capacity, you never say 25 million, you don't achieve your average, capacity utilized unless you have that capacity. So you have to take 85% of capacity as a target on a production.
Okay.
And the clinker balance. You cannot take on a peak production. It doesn't happen. The plant doesn't run on that basis. The demand is also not there on that basis.
Understood. So more of a distribution strategy you're looking at. Great, sir. I think that's all from my end. All the best.
Thank you. We'll take a last question from the line of Ram Chakravarti, an individual investor.
Good afternoon, sir. Thank you for taking my question. My question is very simple, that with the rise in the fuel and other input costs, on a percentage basis, what do you think would be the effect on EBITDA for Q2 if you compare it with Q1? Thank you very much.
So our EBITDA in Q1 is 19%. And if we see the effect of the cost increases and also some fall in the prices, there should be a reduction of about 6 to 7% in the EBITDA on this count.
Okay, 6 to 7% or from 19%.
It will be the drop. It will be around 30% would be the drop in the EBITDA.
Okay, 30 to 35 basis points.
Yeah, 35%, yeah. So, but close to around 400 rupees a ton could be, the drop in EBITDA.
Okay. And this will be temporary. So by Q3 things would look up, right?
Hopefully, yes.
Okay. Thank you, sir, very much.
Thank you. I would now like to hand the floor back to Mr. Vaibhav Agarwal for closing comments. Over to you, sir.
Yeah, thank you. On behalf of Phillip Capital India Private Limited, I'd like to thank the manager JKCEMENT for the call, and many thanks for apart from joining the call. Thank you very much, sir. Invite you now conclude the call. Thank you.
Thank you, Vaibhav, and thank you everyone for joining.
Thank you.
Thank you.
Ladies and gentlemen, on behalf of Phillip Capital India Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your